Hello, the National Business Information Clearinghouse and Entrepreneurial Development Center welcomes you to our Beginner's Guide to Financial Statements. This module focuses on the income statement. An income statement is a summary of a company's profit and loss over a specific time period, usually a full year or part of a year. In fact, the income statement is also called a profit and loss statement, or P&L. An income statement shows the income earned and expenses paid by a business during the period being reported. Overall, it helps you determine how well the business is doing by showing what kind of sales were made, how many returns there were, what it cost to run the business, whether there were unexpected expenses, and what your income tax liability will be. Now that you know why it's important, let's discuss the specific sections of an income statement. You can think of an income statement using this simple formula. Revenue minus cost of goods sold equals gross margin, or gross profit minus operating expenses equals net income. The top line of the income statement lists the total revenue that came from the sale of products or services. The top line is also called gross revenue, sales, or income. These sales represent all the money earned but not necessarily collected yet. Why is it called gross? Because on the top line, no expenses have been deducted yet. From the gross sales figure, you then deduct any product returns or sales discounts. Cost of goods sold represents the costs associated with making your product. This includes raw materials, labor, and shipping to manufacture the product. The cost of goods sold is also referred to as a variable expense. That means that the expenses vary depending on how much product you make. Remember, income minus cost of goods sold equals your gross margin. From the gross margin, you deduct operating expenses, which are different from cost of goods sold. Operating expenses cannot be linked directly to the production of your product or service. Instead, think of operating expenses as the cost to operate your business. This can include marketing and advertising, salaries, rent, insurance, and utilities. Depreciation is an annual expense that spreads the cost of equipment like copiers, printers, and computers over a span of time. Operating expenses are known as fixed costs because you incur the expense whether or not you sell your product or service. Gross margin minus operating expenses equals operating income. Operating income is also known as earnings before interest and taxes, EBIT. From here, we account for interest income and interest expenses. Interest income is the money you make from savings, and interest expense is the money you pay on loans. Finally, the amount of income tax you owe to the federal, state, and local government is deducted, and you arrive at the bottom line, which is called net income, net profit, or net earnings. Net income tells you how much the company actually earned or lost during the specified period. It is a result of subtracting all the expenses from your revenue. Since it's the last line of the income statement, net income is also referred to as the bottom line. To review, an income statement shows the following information. Revenue minus returns and discounts equals net sales. Net sales minus cost of goods sold equals gross margin. Gross margin minus operating expenses equals operating income. Operating income minus interest income, interest expense, and income taxes equals net income. Most income statements calculate earnings per share, or EPS. This tells how much money shareholders would receive for each share of stock they own if the company distributed the net income. Stated in its most simple form, the EPS equals total net income divided by the number of outstanding shares. It's time to test yourself. Answer true or false. The income statement shows sales and expense activity over a period of time, while a balance sheet shows activity during a specific point in time. The top line of the income statement is also called net revenue. The cost of goods sold is considered to be a variable expense. One example of an operating expense is the raw materials used to manufacture a product. The bottom line is the net profit after subtracting all the expenses from your revenue. Congratulations! You now understand the elements of an income statement. For more information about this topic, you can visit one of our customized business information clearinghouses. These websites give you access to a variety of free resources for starting and growing your business. Click on the EDC button to view additional online training topics, including the entire Beginner's Guide to Financial Statements series. Thank you for visiting the Entrepreneurial Development Center presented by the National Business Information Clearinghouse, The World of Business, translated. This program was made possible by the generous support of our founding sponsor, Western Union.